Hello, my name is Cody Rex, and thank you for joining me for this presentation on bond investing fundamentals and analysis of a 30-year callable bond. This presentation is part of our Week 2 assignment for MTG 6001 Finance for Managers. Today, we'll walk through key bond concepts, explore why different entities issue bonds, and examine the Chapter 5 problem number 24 case study that illustrates how bond structure impacts yield, pricing, and investment decision making. To provide a brief presentation overview, here's what we'll be covering. First, we'll define what bonds are and who issues them. Next, we'll review important characteristics of bonds, including par value, coupon rates, maturity dates, call provisions, and sinking funds. We'll then analyze the Excel case study mentioned earlier to understand how yields are calculated and what they mean for investors. This includes yield to maturity, current yield, capital gain loss yield, and yield to call. Lastly, we'll revisit key yield comparisons and investment takeaways. What are bonds and who issues them? Fundamentally, bonds are debt instruments. They are promises to repay borrowed money with interest issued by corporations, governments, and municipalities. Unlike stocks, bonds do not provide ownership. They provide repayment and interest over time, and principal is repaid at the time of maturity. Corporations issue bonds to fund growth, acquisitions, or even restructure existing debt. Governments issue bonds to finance spending and infrastructure, and municipalities use bonds to fund public services like schools or roads. There are many different kinds of bonds, ranging from treasury and municipal to corporate and foreign bonds. Each type carries distinct levels of risk as well as potential return. Why bonds are issued and how are they structured? Companies and governments issue bonds rather than sinking bank loans or issuing new stock because bonds allow them to raise large amounts of capital quickly, retain shareholder control while securing funding, take advantage of favorable interest rate environments, and finance long-term investments or address budget needs. Issuers may include special provisions such as callability to allow for refinancing later. As noted by Robbins and Schatzberg, 2003, callable bonds provide flexibility to manage interest rate risk and adjust capital structure. Here are some structural characteristics of bonds, including their par value, coupon interest rate, the maturity date, provisions to call, and sinking funds. Now let's take a look at some fundamental bond features starting with par value and coupon rate. Par value is a bond's face value, usually 1,000, which is repaid at maturity. It's also used to calculate interest. The coupon interest rate determines how much the bondholder receives annually. For example, an 8% coupon on a $1,000 bond pays $80 a year. The interest is typically paid in installments, semi-annually, quarterly, or however the bond dictates. Whether a bond sells above or below par value affects its yield. Buying at a discount increases yield, while buying at a premium, like in our example, reduces it. This impacts how appealing the bond is to investors. Maturity date and provisions to call. Maturity date tells us when the issuer will repay the bond's face value. Bonds with longer maturities tend to carry higher interest rate risk, which could impact investor demand. Moving on, let's talk about call provisions. Call provisions allow issuers to repay the bond early, such as in order to refinance a lower interest rate. While this benefits issuers, it creates investment risk for bondholders who may have to reinvest at lower rates. Callable bonds usually offer higher yields to compensate for this risk. Call provisions are generally less favorable to investors as they often influence a bond's valuation. Sinking funds. Sinking fund provisions require issuers to periodically retire a portion of the bond issue prior to maturity, thereby reducing credit risk over time. Emery, Llewellyn, and Maurer, 2004. Sinking funds are a provision that allows issuers to gradually pay down debt over time, reducing credit risk and building investor confidence. For investors, a sinking fund makes the bond feel more secure, but it also means the issuer might pay back part of the bond early on a set schedule, which may not be ideal timing for the investor. 30-year callable bond case analysis. Using the concepts we've explored, Chapter 5, Problem 24 shows how different bond characteristics influence investment outcomes. We analyzed a 30-year bond with a 7% annual coupon, paid quarterly, which may be called in 10 years at a call price of $1,100. The par value is $1,000, and the current market price is $1,200. This bond has 4 payments per year, with each payment equaling $17.50. That totals $70 in annual coupon income. Since this bond sells for more than its par value, we can observe that it affects the yield to maturity and yield to call. Yield to maturity and current yield. Looking at the Chapter 5 Problem 24 case study, the first metric we'll calculate is the yield to maturity, or YTM. This figure represents the total return an investor would earn if the bond is held for the full 30-year term. It considers all future coupon payments, the purchase price of the bond, and the final principal repayment at maturity. Since the bond pays interest quarterly, we're working with 120 total periods, 30 years multiplied by 4 quarters per year. Each quarterly payment is $17.50, based on a 7% annual coupon applied to 1,000 par value. To calculate YTM, we use Excel's rate function, which requires the number of periods, 120, the periodic payment, $17.50, the current price, entered as negative $1,200 to reflect a cash outflow, and the future value, which is the $1,000 par amount returned at maturity. This gives us a periodic yield to maturity of 1.40% per quarter rounded. To express that as an annual nominal rate, we would multiply by 4, resulting in a 5.61% annualized YTM. This rate provides a more complete picture of the return than current yield, as it includes both the interest income and the loss of principal due to buying the bond at a premium. Further down, current yield is simple to calculate. It's just annual coupon divided by current price. In this case, that's 70 divided by 1,200, resulting in a current yield of 5.83%. As Brigham and Earnhardt, 2024, explain, the YTM reflects the total return over time, where current yield only considers annual income. Capital loss or gain. Since this bond was purchased at a premium of 200 over par, there is an expected capital loss. The current yield of 5.83% exceeds the yield to maturity, YTM, of 5.61%, meaning that part of the return is reduced because the bond was bought for more than its face value, and that extra amount won't be paid back. The capital loss yield is calculated at 0.22%. That's the YTM of 5.62% minus the current yield of 5.83%, resulting in a small but noteworthy reduction in the return. This underscores the importance of considering both yield types before investing. Finally, calculating yield to call. If the bond is called in 10 years at $1,100, an investor would receive less interest over time and a smaller principal repayment compared to holding until maturity at 30 years. We calculated 40 quarterly periods for YTC with the same $17.50 payments as present value of $1,200 and a future value of $1,100. The periodic YTC is 1.30%, which annualizes to 5.19% rounded. As Annette et al. 2009 point out, the biggest risk in bonds isn't necessarily default, it's the loss of purchasing power. Callable bonds add to the risk by shortening the investment timeline. Yield comparisons and investment takeaways. In summary, the yield to maturity, YTM, of 5.62% shows return if held to maturity. It includes all future interest and return of principal, taking into consideration that the bond is held to the end of its 30-year life. It's slightly lower because the bond was purchased at a premium, so the investor loses $200 over time. The current yield of 5.83% reflects the annual income. It's a more straightforward measure that looks only at current year's income of $70, divided by the bond's price of $1,200. It's higher than the yield to maturity, YTM, because it ignores that future capital loss. The lower yield to maturity, YTM, compared to the current yield means part of the return is reduced to overpaying for the bond. Capital loss yield represents the part of the return lost by overpaying for the bond. In this case, it's about 0.22%, showing that not all of the income is actual gain. The yield to call, YTC, of 5.19% shows return if called in 10 years at $1,100. It's even lower than the yield to maturity, YDM, because an investor has even less time to earn interest and only recovers $1,100, not the full $1,200. The lower the return if the bond is called shows why early repayment is a risk for investors. Investors should carefully examine bond structure, callability, and market price before deciding to invest. A bond that looks attractive based solely on coupon payments may have other investment risk or capital loss potential.